Hi, my name is Jason Weeks. I'm the co-founder of Endurable.com, and I'm here today to talk to you about interest offset accounts. Not the most riveting topic, but one that comes up quite often when I'm chatting to people, and they say they have a home loan or an investment property, and being the curious property nut that I am, I always ask, do you have an interest offset account? Do you have a mortgage offset account? And it's interesting to hear people say, no, I've heard about it, I've got one, I don't use it, I haven't heard about it. More often than not, even though people know that it's a good idea or know a little bit about it or have heard that others have it, they don't have the product, or if they have the product, they're not really using it. So I thought I'd take the time today to explain what it is, how it operates, and some of the benefits, as well as some of the drawbacks to keep a bit of an even keel. So a mortgage offset is no different to a checking or a transactional account functionally within the bank. It's just a case of retail deposits. You put money in. But the difference is that it is linked to a loan account. So when you purchase a property and you have a mortgage, there is a loan balance, and that loan balance against the asset has repayments. And the repayment typically is either an interest only, that is, you're only incurring interest monthly or weekly or fortnightly, however you're paying, and there's no reduction in principal, or it's a principal and interest loan, and you are paying each month, week or fortnight, some interest component and some principal component. And when a loan is first cut, there is a repayment amount, regardless of the type of loan, and that typically doesn't change, even though interest rates may change. It's set initially, and it is the amount that you will pay every month, week, fortnight for the life of the loan until the loan is either repaid, or in the case of interest only, it's required to be refinanced. And so an interest offset account is a checking account or a savings, transactional account. Banks call them different things, but largely it's a transactional account, and it is linked to the loan. And what's important about that is that your loan, even though it might be repaid weekly, fortnightly, or monthly, it accrues interest typically on a daily basis. And with that in mind, interest offset accounts are an excellent product for reducing the interest that is charged to you on a daily basis, even though you're making payments on a weekly, fortnightly, or monthly basis. So every dollar and cent will count in what I'm talking about, because the interest is calculated daily, even though that's not necessarily shown to you in the loan balance repayments or the information that is coming out to you on a weekly, fortnightly, or monthly basis. So why would you use an interest offset account? Well, an interest offset account, as I said, is linked to an account, and what happens is the amount that you have in the interest offset account, let's say it's $50,000, will have the interest attached to the loan amount of the same amount. So $50,000 if it's in your interest offset account, and $50,000 if it's part of your loan balance, the interest will be offset. So they will not charge you interest on that amount. And what that means is you're getting quite a high interest rate for normal savings. So let's use an example. A normal savings account, even one with bonus interest, might at the moment in Australia be paying 1.5% to 2%. I know there are products that are higher if you want to lock it away for a term deposit, but I'm just talking about a basic savings account. And your mortgage, even though it's come down a lot in the last little while, most interest rates, even on a super great rate, are still going to be 3%, around the 3% or north of 3% mark, and higher if they're interest offset or you're a higher risk client to a financial institution. And so you're going to get a better equivalent rate on money that is held in a checking account than you can in the best savings product for a bank. So what does it actually mean for you though if you hold money in an interest offset account? What does reducing the amount of interest you pay do to your loan? Well, it does two things. So obviously it reduces the amount of interest you pay. So the monthly amount that you're paying, even though it's staying the same, will either actually, if it's interest only, if you have the same amount in there, would be no interest on that portion. Or if you have a principal and interest loan, then the amount that your interest component is offset. And so because you're paying the same amount each month, typically cut when you originated the loan, it will actually in fact reduce the principal of your loan, and as a result, it will shape the loan term. So if you took out an initial 30-year loan every amount you have in the interest offset over the life of the loan will reduce the amount of interest you pay, and as a result, increase your principal repayments. And what that does is it brings forward the term of your loan. And it has an accelerating effect. So the more you do earlier, and the more you do generally throughout the life of the loan, the more you'll accelerate the loan of the term of the loan being brought in. Now, I have to talk about some cons, because I've talked about the two pros. So the life of the loan and reduced interest component. And those two are linked. Let's talk about a couple of cons, just to keep it even keel. The first I would say is, you do have often fees attached to running an offset account, so they're not often free. There'll be some sort of annual fee. So it is important you use it, because if you just have it, like a lot of people I know, and they don't use it, you're incurring fees for a product that you're not using, which just doesn't seem right, and you're handing money to your financial institution for no reason. It'd be great if they're free, but typically these packages are not free. They're usually linked to other things. There is some extra hassle. So yes, I appreciate if you've got money in and out of an offset and moving around, yep, you're going to have to do a few more transactions and this, that, and the other. But these days with mobile banking and internet banking, it's not like it used to be where you had to go into a branch. Functionally, this is quite an easy thing for you to do and execute. And there is the other school of thought that is, well, if you had extra money over and above, it should really just be sort of, reducing principal. So if you're on an interest-only loan, great, but perhaps you should take the view that, well, rather than have an interest offset, if I have extra cash flow, I should really just be tipping it into paying down the loan. And that's a valid point too. You could just actually engage in extra principal repayments and, rather than actually using an interest offset. The counter to that is, once you've made an extra repayment and a loan is paid down, typically, you've reduced your flexibility there to take the money back out if you need it, if it's part of your sort of emergency transactional savings. And also as well, some lenders, or depending on the way your loan is constructed, will penalise an extra repayment, or you might have a cap as to the amount you can repay. So what I want to talk about now is the difference between a partial offset and a 100% offset. So a lot of lenders will only allow you to have a portion of your loan have an interest offset, and what that ends up being is you might have a portion of your loan that you fix for a period of time. It's quite common in the low interest rate environment that people like to lock in lower rates, and then a portion of your loan will be variable, and it's that variable portion that often can have an interest offset attached to it. That's just the difference between partial and 100%, and 100% offset really could mean that you could have the entire value of the loan offset, an entire amount also equivalent into an interest offset, and you would have no interest payments. It would only effectively be the same as principal coming out every single month. So let's chat about an example, because I want to give you some numbers around just how much you can save to try and emphasize the benefits of using it. The first thing I'd say is, let's just, I'm just using these numbers as an example. They're not perfect, but I'll put some links to some calculators so you can tweak your own that I quite like using. If you bought $1 million property, and if you borrowed $800,000, so 80% LVR as we talked about before, and if the life of the loan was 30 years and the interest rate was 4%, just keep the numbers super simple. If you built up over time savings equivalent to $15,000, and you put all of that into the interest offset at year 10. So let's say you've been saving $5,000 a year for 10 years, and you had $50,000 as your sort of emergency pot of money. If you put that into an interest offset product at year 10, so we're 10 years into a 30-year loan, then from year 10 through to year 30, you wouldn't reach year 30. You'd actually pay off your loan at year 28 and 10 months. So you would actually save an entire year and 2 months on the back end of your loan just by putting that amount of money into an interest offset. Now, a lot of people would say, well, I don't have $50,000. Well, just as an example, I've only started that at year 10. And also as well, I haven't been running it through maybe at a higher volume along the way. And I also may have actually had bonuses that might have reduced principal across the term. What I'm just trying to emphasize to you is that if you had $50,000 from year 10 through to the end of the life of the loan, you would save the equivalent of $56,000 in interest. And I'll put this in a link for you in the show notes. And you would save a year and 2 months. So there's significant power to using an interest offset. and it's to do with saving on interest and as a result saving on the time, the life of your loan. How can you make the most of it? Well, the first thing is use it, please. If you're incurring fees to your financial institution, you should be using this account. The second thing is you should be tipping your salary into this account because that is the single largest chunk of cash that you get every month. So if your salary is going into your interest offset account, excellent, because then what happens is you can live your life over the course of your month out of that interest offset account. And then as a result, you get the maximum bang for your buck on a daily interest basis across the time of the month. And then next month you'll tip it in again, and any residual you should just leave in there until you actually need it. And then finally, the third thing you need to do is, as I said, live your life out of that account. So if you can, just do your very best to leave as much in there as possible, tip all your savings in there as possible. The reason being that interest rate is currently better than any savings rate that you will get on the market for your daily checking savings account. It is the best use of your money. Of course, if you want to if you want to invest and you've got retirement and other things, those are longer term, higher bearing interest options. But if we're talking about where your day-to-day money should be parked and you have a mortgage and you have an interest offset account, it should all be in there, all of it. So I hope that's brought some value to you. I'd love to hear your thoughts. Let me know if you have an interest offset account. Let me know if you knew about what it was before I was talking about it. And more importantly, if you have any other questions or you'd love to know something about property or personal finance, I'd love to chat to you about it. Thanks very much for watching.